Good afternoon, everybody. We're going to be getting started in just a couple of minutes as the rest of our guests join us here this afternoon. Well, good afternoon, everyone. Thank you for joining us here today for our economic and market webinar with City National Rochdale. My name is Sam Irvine. I either work with or have had the privilege of meeting many of you, but for those to whom I am an unfamiliar face, I am one of the financial planners here at Davie Kaplan Wealthcare, working alongside the partnership group and my colleagues Fran Ostrom and Chris Sassone. As a brief overview of our agenda today, our prepared remarks will be about 30 minutes in length, and then we will have about 10 to 15 minutes for your questions at the end. Respective to any questions you may have, we certainly encourage you to participate. If you would like to ask a question, please feel free to type it out in the Q&A box at the bottom of your screen, or you may raise your hand and we can unmute you at the end of the webinar. For now, everyone is muted, and this session is being recorded for anyone that would like to listen to the replay after the webinar. Many of you joining us today on the call are familiar with our partnership with City National Rochdale, especially with respect to the manner in which they help us and you as our clients to design thoughtful and personalized investment portfolios. We certainly value their expertise and are privileged to host today's webinar in partnership with them. With that being said, I'm going to hand it over to CNR's Senior Investment Consultant, Michael Nelson, to introduce our guest speaker from CNR, Charles Luke.
Thanks, Sam, and good afternoon, everyone, and thanks again for joining us today for this market update webinar. Again, my name is Mike Nelson. Sam said I'm a managing director and senior investment consultant with City National Rochdale, and I have the pleasure of working very closely with Sam and the entire Davie Kaplan Wealthcare team in developing personalized investment strategies for our shared clients, taking into consideration each client's unique set of goals and objectives. We're joined today by our key speaker, my colleague, Charles Luke, who will be sharing City National Rochdale's latest economic insights and outlook for the capital markets. Charles is a managing director and co-director of fixed income at City National Rochdale. He's responsible for investment oversight, strategy, and performance of taxable bond portfolios and funds, and is a voting member of our investment strategy committee. So Charles, I'm going to turn it over to you for today's presentation, and I'll join you at the end for our questions and answer session.
Great. Thanks, Mike. Thanks, Sam. So first and foremost, welcome everybody. It's great to be with you this afternoon. Lots going on in the economy, lots of conflicting things. So we'll try to unravel the different opposition that we see in the market in terms of the economic data, especially that we've gotten here in February. So what we wanted to start with was to lay out the landscape, some of the things that we're most concerned with and watching on the economic outlook front, and then also just summarize some of our investment strategy points and the things that we're discussing and talking about for positioning on the investment strategy committee. So I think the biggest issue right now that's happened is the market is confused. We've had a raft of positive data and we didn't expect it. So whether you look at retail sales, home prices stabilizing somewhat, not falling as dramatically as they were earlier in the year, employment posting a huge number, so 517,000 jobs for the month of January, which was about a 400,000 job beat, which is just something that you don't see very often and way out of line with expectations. And then we've seen measures in the economy of service and manufacturing. And we look at the ISM surveys, it's the Institute of Supply Management. So those have been also coming in pretty hot. And so to start, when we think about our recession risk, and this is the top bullet on the left-hand side, we've had that pretty consistently for the past 6 months around a 75% level. But as we've gotten some of this data and have a little bit more knowledge about what could potentially happen with the growth slowdown, we've taken that down to about a 65% probability of a recession. And we'll talk about the different breakouts between what we think about a slowdown in growth, between a mild recession and a severe recession. But we do believe that this is an environment now where the risk of a normal recession or severe recession has diminished almost to a 0% probability. We continue to expect the Fed to tighten through 2023. So previously we were seeing the Fed getting up to a rate of around 5 to 5.25. It could go beyond that now. The market is really pricing in expectations that will go beyond that. I think what we have to remember with the market and a lot of what we hear potentially with these futures and options that are priced off of Federal Reserve funds, just the forward expectations for that, people are still trading that, right? So it's fallible in the sense that you and I could go out, we could buy a future, we could buy a forward, and they've been very inaccurate pretty much all year long. So we're going to be sticking with our 5 to 5.25 on the peak Fed funds rate until we see meaningful data that confirms a lot of the positive situations that we've seen. And there's a bullet point in the middle on the left-hand side. It's kind of a catch-all for everything consumer related, but you've got job gains, wages, savings, and net worth, and supporting the consumer and all of that. So one of the questions that I've been getting, and it's been a little bit difficult to answer, so I can unpack it a little bit on this page and we can talk about it more when we get to the consumer. But we see credit card balances rising, delinquency is starting to tick up a little bit, and household wealth has fallen. We've also seen the composition of consumer spending change. So we shifted from kind of discretionary goods, and we've seen more in terms of necessities like gas, groceries, and restaurants. And you're also not seeing the impact of home prices really in home equity. We think household prices are going to fall more, so home prices are going to be going down. But the one key to consider and remember with spending is that the debt service burden on the consumer right now remains well below previous recession levels and definitely well below what we saw in 2008. So we don't see the consumer creating a credit environment that's going to be negative. What we do think is that wages that have been increasing, especially on a nominal basis, so not adjusting for inflation, are going to help drive the continued spending for the consumer. And we think that's very healthy. We'll talk about some of those characteristics while we get there. So even though we're seeing a little bit of a degradation, we still believe that the consumer will continue to be in a positive situation unless the Fed were to push rates so high that it creates a hard landing and the economy slows and unemployment ticks up dramatically. And then 2 points on the overall economy, some risk factors that we see, but we're very watchful on the private markets. So in a nutshell, what we saw since around 2010, 2011 was a huge explosion in the amount of credit issued from private corporations. So this is a sector you may have heard referred to as direct lending. So basically businesses making direct loans to businesses, like we saw with banks before 2008, but with the regulatory environment, they've been forced to step out more of that market. So direct lenders have stepped in. They're directly exposed to rates because most of those deals are floating rate. And so we think that at a 6, 7, 8, 9% type of level, that could be a big risk factor, but there's a long runway because a lot of those deals don't have to be refinanced. But we like to mention that just because if we were to pick one factor in the credit environments that we're watching closely, it is the private debt markets. And then just to round out the economic outlook, we do still believe that the US economy is the most resilient economy in the world. So if you look at Europe and Asia, even though that differential, you've had a pretty big rally over there as expectations have reset, but we still think the impacts from the Ukraine war and a lot of what we're seeing geopolitically has a bigger probability of hurting those economies, and we can be more resilient here in the US. So we still have that domestic tilt, that domestic lean. And so shifting into the investment strategy portion, we're still positioned defensively. So our biggest probability when we look out over the next 6 to 9 months is that we're going to be in a situation where growth will slow down or we'll enter a mild recession. So we are positioned defensively. We're underweight the equity markets. We've taken a position where we've now overweighted investment grade bonds in our portfolio. And there are a lot of different things to do from a fixed income perspective based on the level of yields that make being in that market much more attractive, probably the most attractive that we've seen in 15 years, especially for liquidity management portfolios. And we think about the level of returns we could see in risk markets, especially equities. We do think they could be moderately positive in 2023. A main reason for that is we're going to see a lot of volatility, but if we do have this gross slowdown environment, it'll put us in a situation where we know more about what the economy is going to do, and we'll start to price in what the potential recovery could look like after we go through that transition period. And markets will adjust to that. So we could potentially see a lift up toward the end of this year or in the beginning of 2023. So we do think we could hit a positive level, but it's going to come with a lot of volatility. And then if we shift into fixed income specifically, what we really like right now are investment grade corporate bonds. So if you look at what we're earning there, the average 10-year corporate investment grade bond, so high quality bond, is yielding about 5.7%. And even when we compare that with municipal bonds, which are popular to get the tax exemption, it's more than double what that muni bond yield is. And so what that means is even after taxes, you're going to be better off in the corporate high grade markets. And so we really like what we're seeing there. We think the risk premiums are well priced. And again, that sort of an income in your portfolio is going to help drive that 40%, 30 to 40% of your portfolio that's non-equity. And then for investors that are looking to take a little bit more risk, in the last bullet points on the right-hand side of the page, we do believe that high yield markets will be attractive at some point this year. We had a really big rally that started back when rates peaked in October and followed through to the end of January, but that's reversed a little bit. So we'll definitely talk about what that looks like in the fixed income section when we get there. But we are in a situation where we do think there will be pretty extreme opportunities there going forward. Whenever we see those risk premiums, the cost of entering high yield debt start to increase because of concern, forward returns do look very, very attractive. And then, as I mentioned, we see a lot of opportunity in the cash markets, especially in liquidity management. So what about our specific forecast? If we go to the next slide, I think one of the biggest things that we've done, and this material was updated for January or early February. And so I'm on the investment strategy committee, so I have the benefit of knowing real-time changes that are occurring on the committee. And so if you look at 2023, based upon some of this good data, our GDP forecasts have taken that low end up to around a negative 1% level and the high end at 0.75% to around 1%. So we're seeing a slightly better tilt on the positive side and sort of a balanced growth situation when we think about kind of that 0% level on the overall economy. So it's moving in the right direction, but we're not ready to say we're just going to have a growth slowdown. We still think a mild recession is the highest probability. And when we think about corporate profit growth, this has been a real wild card, right? We came in above expectations when we thought things were going to be low pretty much all through last year. Even in the fourth quarter, although earnings did decrease down about 2.5%, they still exceeded a lot of the estimates that came in from a revision perspective right at the end before everything was all said and done. And so corporates have been extremely resilient. They've been able to pass a lot of costs on. Margins have stayed high. And so we still expect those earnings revisions to continue to move downward and for earnings to be challenged for many different reasons. But again, the overall economy, corporate health seems to be very high quality right now. And it has been a wild card, although that range is going to be very high. So in 2023, we see that somewhere between negative 6.5% on the very low downside and about 1.5% for the full year. And then when we think about inflation, we'll spend a lot of time sort of hitting inflation. But for us, based upon what we got for our consumer price index and then personal consumption, so you've heard that referred to as CPI and PCE, those came in a little bit higher than expected. And so we do believe that we're probably going to be at about 2.8% for that headline CPI. So just that big number on CPI, the core number that everybody sees. And then for the core, so excluding food and energy, we think we're going to be up around a 3.2 to 3.3% level with some of our recent adjustments. And with the Fed and rates, this is probably the most interesting part, maybe the hardest thing to forecast, but we're sticking with that 5 to 5.25 range right now to see some follow through in the data that we've been getting, and just looking more at where the Fed's going to be, how it's going to impact the economy, where unemployment actually is by the time we get into the middle of the year. And then the 10-year Treasury note, this is probably the biggest revision that we made, but we moved our 10-year target at the end of this year up to between 4 and 4.5%. So the reason for that is we think the Fed is going to be on hold for a while at 5 to 5.25. And I just mentioned how if we go into sort of a growth slowdown, it can put us in a situation where we have a little bit more knowledge about what could happen on the other side of that. If that were to occur, this difference between short-term interest rates, so where the Fed is, let's just call that 5 to 5.25, and longer-term rates, so kind of 10-year Treasuries, those 10-year Treasuries have been well below where that short end of the curve has been. And so we think the risk is that the 10-year Treasury, if we know more about what the economy could look like towards the end of this year or at the beginning of next year, we think that could put pressure on the 10-year Treasury up to closer to where short-term rates are, which makes it very vulnerable. So that's why we moved that target so much from 4 to 4.5%. And we think we're going to continue to see that trend throughout 2023. And just to touch on it briefly, if you go to the next slide, one of the things that we show that simplifies a lot of our forecasts for the economy is what we call our speedometers. And so for February, here's what we see. Not a lot of green, no green on this page. It's all yellow and it's all red. And so some of the specific things that we're watching very closely, some of these dials that could change and shift, would be housing. And housing has been a little bit of a mixed bag because we've seen prices moderate in terms of the downside movement. But we also have areas of the country, things like Nashville and Austin, that are still booming from a home price perspective. So we're watching it very closely, as well as the influence of mortgage rates on that market as well. Labor, we've already hit on that a little bit, but that's going to be a big component of what the Fed is trying to do. They're trying to get that unemployment rate up. They're trying to kind of reduce or create slack in the labor market, and that's going to be critical if they want to slow down the economy and get a handle on inflation. So that's going to be a big topic going into the end of 2023. The yield curve, so this idea of lower long-term rates versus short-term rates, we call inversion. That's something we're watching closely in terms of its signaling and predictive power of a potential recession. We do think that will unwind. Long-term rates will move higher. And then we don't talk about this too much on our speedometers, but our business outlook and our credit demand speedometers. What we're starting to see is that banks are bringing in credit. They don't want to make loans in this environment. Part of it is the regulatory environment, some of the tick up in the delinquencies, but that to us filters through a little bit to the consumer. So some of the comments that I made at the beginning, and then looking at the business outlook. If loans aren't as available for businesses, they're not going to be able to make as many investments, research and development, capital expenditures. And so that is a situation that we're watching very closely as far as these speedometers are concerned. But given that these are mostly red and yellow, again, we're still positioned defensively. We still think there is risk for more volatile markets like equities and like high yield to reprice here. And so to bring it all together on page 5, if we go there, if we kind of think about this as a circular influence across everything, it results in this higher for longer outlook. So it started with inflation, it sort of moved into geopolitical risk, that's hit interest rates, and it's created economic volatility. So given that rates are going to be higher for longer, this circle is going to continue until we get a break in one of these components. So inflation and interest rates will be heavily connected to one another. Geopolitical risk and volatility clearly will be connected. And so we're looking to see what sort of loosening we could have in one of these characteristics that could sort of break this cycle of high volatility and get us on sort of a trajectory where we think risk market returns will be positive in the future. And so moving to page 6, getting into some of the detail, when we think about what the economic environment will be going forward, we think that the probability of slow growth has increased. So on this page, we're showing it at about 25% in our last update. The committee just moved that up to 35%. We've kept our probability of a mild recession at around 60%, so we haven't adjusted that. But we've taken the probability of a normal recession down to just 5%. And there are many reasons for that. A lot of it has to do with the strength of the financial system and overall credit quality and balance sheet health in the broader economy. We don't see the same sort of situations that we saw in 2008 with the credit excess in the mortgage market. It's very hard to pinpoint a sector that looks anything like that. So I talked about private equity and some of the private debt markets. That's probably the biggest risk factor we see in credit, but it's nowhere near the amount and impact of what we saw in the mortgage market and the outright and blatant fraud that we had in terms of home buying and financing. And so on the next page, just to describe a couple of the factors that we could see and that would characterize each one of these options going forward. And I want to be clear about this too. Just because you could have slow growth and it's in green, that's economic related. It doesn't necessarily mean that markets will follow. And so to kind of catch on to what I mean by that, let's go through just a couple of these points. So let's first sort of look at labor, right? So the pace of hiring slows, the job gap narrows. So it's still kind of a moderate to neutral factor. But let's say interest rates remain elevated. So at this kind of 4.25% to 4.5% level, that's not necessarily great for the economy. And the Fed will continue to tighten policy, which is potentially going to spook the risk market. So that's why I said at the beginning, we have all of this conflicting data where you have sort of one point saying one thing, this looks good, another point saying this thing, this looks bad. But overall, what we're really trying to figure out is when is that point where we get back to neutral weight and potentially overweight equity? But we're just not at that position yet, even if we have any one of these scenarios play out. Certainly could look the other way in a couple of months when we have more data, but it's still very uncertain. And so we think about a mild recession, inflation gradually easing, Fed policy pausing, that actually could be one of the best case scenarios for the economy. Usually we see about a 3% pullback in growth when we talk about a recession. If we see somewhere between this 0 and -1% and the economy is resilient and rates remain high and the unemployment rate doesn't spike dramatically, that could almost be the best case scenario for the economy going forward. So we don't create a lot of froth, but we'll create a good foundational base moving forward for risk assets. And then a normal recession, that's probably the one where we know for a fact that we're going to be in a situation where we'll see high levels of volatility and markets could move lower. But if there's a rapid repricing, let's say the Fed starts to cut interest rates, that could lead to more of this V-shaped style of recovery. And so the reason that I mention all those scenarios is just because the equity reaction, the bond reaction, the reaction to rates, all of that can be very different going forward depending upon each one of these scenarios. And depending upon what happens here in 2023, 2024 could look much different going forward as well. But these are the scenarios that we see. These are the expectations that we could have. We're watching closely to see how that's going to impact markets. And so going to the next page and looking at the case for a mild recession, which is our highest probability, we can go through a couple of these charts. I won't get too detailed, but I think it's all good information. So if we look at the top left, so this household debt service burden, I mentioned this when I was talking about the consumer. It's like, okay, well, credit card balances are going up. We're a little bit concerned about delinquencies. But in terms of the overall debt level with consumers, it's still very, very low. And their wages are rising. So even though we don't have as much savings, net worth has gone down a little bit with the pullback in the equity markets and other areas like housing. We think that wages can really drive the consumer going forward and keep spending levels normalized to where they were before we had COVID hit in 2020. So you can see that it's still near about a 40-year low in terms of that debt service burden. So still very low despite the increase in mortgages or sort of mortgage costs on a monthly basis and some other things. So that's very comforting to us when we think about the consumer. On the top right-hand side, if you look at the number of job openings, right, it's still very, very high. So you still have a situation where the job market has almost no slack and companies are looking, it's very difficult to hire people. And so as long as that remains robust, even if the Fed were to adjust that, say the unemployment rate goes to 4% or 4.2%, that would be healthy. That would help them get closer to their goal, but we're still going to have a relatively tight labor market. So that's another positive. If you look at the bottom left-hand side, this is where I talk about banks and the health of the financial system. So if we think about tangible common equity here to tangible assets, all that is a fancy way of saying, what's the capital position of a bank? And you can look back all the way to kind of the 1930s and 1940s before we were at this high of a level in terms of bank financial health and what they have on their balance sheet that's helping to protect them against what could potentially happen from a credit situation or delinquency situation. So that's something that we really think is going to drive a different situation in a recessionary environment and create a better balance to where we won't see a fall off in growth. And the last one is that we talk a lot about how, well, people are spending more on services, maybe goods are falling, but the reality is that we think about services, which is the biggest part of our economy, it's still not back at its pre-pandemic trend. So that's still a good influence on the overall level of inflation and sort of where we are. And we see goods inflation sort of falling. So we're hoping that this filters through to the inflationary environment. We get inflation levels that are lower and a little bit more stable as we move lower. So we were at almost 9%. Now we're down somewhere between that 5 and 6% level. So we've made good headway there. And statistics like this make us feel comfortable as well. And so moving directly into the consumer on the next slide. And this is where spending is really going to matter. So if you look at the left-hand side of this chart, this is real personal spending on a year-over-year basis. So you can see in the pandemic, the consumer started spending a ton of money, right? We had a 25% increase in real personal spending just after the pandemic. And that has made its way down to where it's at a pre-pandemic trend. And so I think a lot of the reaction that we see in the market now is coming from, well, we had these huge numbers. I mean, we put up incredible numbers. You got 30% increase in earnings. You got a 25% increase in real personal spending. Well, we're just back to our trend, right? The trend for the longest time, if you look at this graph, was right around 2 to 2.5%. So there's nothing wrong with having spending growing at that sort of level. In fact, it's much better to have that sort of moderate growth than to have these wild swings in volatility. So I think the psychology of COVID is still really playing a big factor in how these numbers are being interpreted. But it's still a good situation to have personal spending moving in this 2 to 3% range. And we think about real disposable personal income. This is a little bit of a concern, but it has gone up, right? So we're still moving higher. You had savings get bolstered by the increase that we saw up to around 52,000 per capita. It's come down a little bit below that trend, but I also think this is related to the volatility coming out of COVID, just seeing these big numbers and these big swings as the economy really adjusts back to normal. But overall, the consumer, we think, is in very good health going forward. And we're watching each one of these factors very closely. But we think wages are going to be the key driver throughout 2023 in terms of what keeps the level at the level it needs to be. So if we go to the next slide to talk a little bit about housing, and just, we don't have to walk through each one of these, but we generally know mortgage rates are a lot higher, mortgage payments are a lot higher. Housing costs have actually started to moderate a little bit, so affordability has gotten a little bit better. And we did have a brief period in January where the 10-year Treasury rate fell pretty substantially. And that translated through to the overall level of mortgages, but we're seeing that go away a little bit as the 10-year Treasury now moves closer to 4%. And again, we have it in that range of 4 to 4.5. So we expect mortgages and mortgage affordability to continue to be under pressure. And then the last thing on this chart, you just look at new and existing home sales. It is starting to decrease dramatically, but we're still in a very underbuilt situation in the US. So the supply of existing homes, and what we're seeing in terms of the tightness of that market probably means that we're not going to see as big of a decline in the housing market as we would typically see in a normal recession. So that's another area where we think spending will continue to remain high. If we get household formation, if it becomes a little bit more affordable, we're in a situation where we're still going to go out and buy refrigerators, we're going to buy TVs, we're going to do all those things that you do when you buy a house. And so moving to the next page, to talk specifically about inflation, and we can drill more into services and goods inflation here on the left-hand chart. And I think it's very important, right? So a lot of what's been driving the inflationary numbers so far since we peaked has been goods inflation. So goods inflation has come down pretty substantially, while we've seen services start to tick up. And this is actually much more reflective of what the relationship looked like in 2010 to 2019 before we had COVID. And so this adjustment is overall really healthy. The one thing that it gives us a little bit of pause is what happens with services? How high does it get? So it's returning to that trend. It's not quite there yet. Does it bust through that? Does it create additional pressure on inflation? And so that's really uncertain at this point, but we're watching it very closely. I think one of the things that led to the increase in inflation that we saw in these most recent numbers was we had things that were driving it before, like used car prices, start to elevate. So goods inflation sort of reduced or reversed that trend a little bit that it had going into 2023. And it wasn't too robust. I mean, it was moderate. It was up about 0.1 or 0.2%. But most of that increase came from goods, not services. So services is going to be one of the most important things to watch going forward. And then if we think about the forecast for inflation and what our expectations could be, just looking at CPI, we do still expect that to fall. I mentioned the nominal, so the headline CPI number should be somewhere between 2.8 and 3% by the end of the year. The core number, as the nominal falls and as services tends to moderate, is going to be 3.1 to 3.2%. So we do expect inflation to fall, which will overall be a good thing for the economy. And to move to page 12, if we think about the top reasons for a longer Fed outlook, I mentioned that, so I don't have to sort of beat a dead horse here, so to say, but they've got to get the labor market loosened, right? They've got to get some slack up in the labor market. And until they start to see that, we're not going to be in a situation where we can count on the Fed to peak in terms of where they take interest rates and then to reverse that quickly. In fact, I don't think they're going to reverse that quickly. And that leads primarily into this higher for longer outlook, where we're going to see them at the top end of their potential kind of rate peak, so somewhere between 5 to 5.5, until they see the labor market start to come undone a little bit. So that's going to be the primary influence. So let's go to the next slide. And that gets into what we all hear about, and I think it's a sort of a popular thing to say or way to put it, is that when the Fed raises interest rates, they have the risk of a policy misstep or creating some sort of hard landing. And so we'll see what ultimately ends up happening. This one's a really hard thing to predict. Again, we thought we were going to get some bad numbers. We've gotten some good numbers. And so the probability of a soft landing, a slow growth scenario has definitely increased. But if they don't see the type of loosening that they want to see in the labor market, it is going to create a situation where they're going to feel under pressure and their credibility will be threatened if they don't continue to increase rates and get inflation under control. So when we kind of get into these environments, we're looking for how far does the Fed need to go? What's the impact going to be? Has it all translated into the economy yet, since they started doing it just in March of last year? So all of these things are going to be things that we're paying attention to moving forward. But that risk of a policy misstep is something that's always front and center in our minds. And so to move a little bit into positioning and sort of wrap up my comments and then get to the Q&A, 2022 was really the year that diversification failed. But we have to go back to the longer term statistics and cut through a lot of the noise and be clairvoyant, right? Be clear-minded and headed about what we need to do to position. So on the left-hand side, you can see the 60-40 annual total return. So it was one of the worst on record, about down 16.1% in 2022. And we haven't seen that since the crisis in 2008. But what we tend to see on average on the right-hand side of the chart, after a 10% decline, we tend to see 6 months after that, about a 3.7% average positive return on a 60-40 portfolio. 1 year, about 16.7%. And over a 3-year period, a little north of 10% annualized, around a 35% level. And one of the most critical things is you kind of see it in the fine print. But in 1 year and 3 year, and I think, Jessica, if you can go to the next slide, I don't know if it's stuck. That happens sometimes. Perfect. So if you look at that middle bar on the right-hand side of the chart, I think the most important thing about what to look at here is that 100% of those 1 year periods had a positive total return, and 100% of those 3 year periods had a positive total return. So it would be very unlikely to see overall returns go negative after the type of year we had last year, especially with the overall level of income that you can earn in investment grade and high quality fixed income. And so let's talk briefly about equity positioning. If you go to the next page, and I'll sort of fly through these, and again, Mike, maybe we can handle some of this in the Q&A. But if you look at earnings growth revisions and where we're positioned, right? So Dow Jones Dividend Select, what we call our dividend income strategy, right? MSCI Quality, so quality stocks, real earnings, not chasing a lot of these high growth companies. And then overall the domestic market, so the S&P 500. If we think about earnings growth revisions to sort of forecast where returns might head going forward, all of those are areas that are looking to be less in terms of that drawdown, that negative positioning, versus something like the all world index, what's happening in emerging market Asia, and what we're seeing more broadly in emerging markets as well. So we're staying away from some of those higher volatility sectors and really focusing on what we think is going to be quality and more stable in a volatile environment going forward. And on the next slide, this just shows our quality positioning. So we're positioned mostly in staples, necessities, really underweight some of the discretionary areas and some of the areas that have run substantially, like the energy markets, like materials. And then just to point it out, our EPS growth outlook in terms of the quality of earnings for our companies is about 14% over a 3 to 5 year period versus the S&P 500 down around 11, and our risk profile is lower as well. So we're trying to create that stability in the market as we move forward, not just with our asset allocation, but individual selections inside of portfolios. And on 17, these are some critical issues to watch in terms of moving forward. And I'll just mention a couple of these because I've hit across the board, but the dollar is an interesting component. And we've seen that start to climb this year after it had a decline of about kind of 15%. And the reason for that is the Fed's back on their tightening cycle. So if we think about the biggest threat to the overall valuation in the broader equity market, it's going to come from interest rates. Right? And when interest rates move higher relative to other currencies or relative to other economies, you're going to get some pressure on valuations. We still think consensus estimates are a little bit too high moving forward, so we think we're set for some revisions there. And there's also an elevated chance of margin compression because it's still very elevated. And we think this could happen if inflation stays higher for longer. We're in a situation where rates really start to take a bite out of earnings. So just to mention a couple of different points that we're watching on equity market valuation. And if we go to the next slide, I didn't want to go through a webinar without really mentioning this because it's front and center, but just talking a little bit about the debt ceiling. What we think is that it's not going to be a major risk factor. We think it's going to create volatility, but ultimately it's not going to hit and hurt portfolios. If you look back 95, 2011, 2013, most of the time, the performance even during the standoff with the debt ceiling and the performance 1 month after is still positive. And on a 12-month basis, it's positive across the board and positive to the tune of about 12.8%. So we're going to be watching it closely. Certainly, we're going to be managing liquidity portfolios that have exposure to things like T-bills, which could suffer if the government were to go over the potential day when they could default. We're watching that and positioning around that so we don't get exposed to it, but we don't think it's going to have any long-term damage on the overall market. And so I'm going to start to wrap it up here. So Jessica, I'm going to ask you to move ahead just to our fixed income positioning. If you go to slide 21, I think this breaks out if we think about the different environments that we could have moving forward. So slow growth, mild recession, and normal recession. Where should you be positioned, especially on the fixed income side? So I'm telling you, we like fixed income. You should have more of your portfolio dedicated there, but what should you own, right? If we have a slow growth scenario, one of the areas that we really like is what we call opportunistic income, which is just more of a term for high yield bonds. So usually, clients, when they think about high yield, they think about volatility. They think about corporations potentially going bankrupt or defaulting, but the probability of that happening in this market is extremely low, especially in the top tier. It almost functions as a very high quality bond, but they could have additional leverage or just some components of their business that cause them to be a little bit more volatile. But in a slow growth environment with higher yields in these areas, we think that high yield bonds would be a fantastic investment. And we think we're looking for probably yields to rise maybe another 3% in that market before we'd think it would be very attractive. But it's something in a slow growth environment that we think would outperform. And then a mild recession, switching over to some of the more high quality bonds we can own. So a 2-year treasury note or short-term corporate bonds that I mentioned, both of those we think are going to be outperformers in a mild recession scenario. Again, that high level of income is going to help stabilize the portfolio, where the low level of income on the volatility of bonds last year helped destabilize portfolios, right? But we went through this adjustment period. And then in a normal recession, we think we'll have a flight to liquidity or a flight to quality. And that's when the 2-year treasury note and other short-term bonds that are high quality are going to be very valuable. So we're really recommending some splits between these things. We like 2-year treasury notes, but we've also taken some shots in high yield to get just high levels of what we call carry, so that yield and income being very high. But this is really how we see it as we move through these different scenarios. And then just to drive home the point on the next slide, we really do believe if we look at our range, so what we like to earn in client portfolios, what we think we need to generate from the non-equity part of the portfolio is somewhere between 5 and 6%. And so just to drive the point home on fixed income, and then we can go to the Q&A section, we're now between that level. We haven't been there since the beginning of 2009, if you look at this yellow line. So investment grade bonds to us, high grade bonds to us make a lot of sense. especially if we can limit the interest rate exposure and just stay on kind of that short 1 to 3 year part of the curve. And then you can see US high yield around an 8.82% level, also very elevated as we move forward. So depending upon your risk profile, what you're comfortable doing, how you can sleep well at night, a good balance between these is going to generate a lot of income in your portfolio and create a lot of return that we haven't had for quite some time. So I will wrap it up there and I'll pass it to Mike for some questions.
Thanks, Charles. That was very, very insightful. So appreciate all your comments and for putting this deck together. The slides were fantastic and really helped illustrate all the points you were making. So without further ado, let's jump into some questions here. We do have a few, and I'm going to maybe combine some of these together if it makes sense. So how long will the Fed stay at the top of their interest rate range? And then we had another one that came in from a business owner and is concerned about higher rates and the impact that that might be having on folks out there, businesses looking to buy other businesses, M&A activity. So the two questions are, how long will the Fed stay at the top of their interest rate range? And do we ever think we'll get back to a lower level of interest rates that we enjoyed during roughly the last decade?
Perfect. Yeah. So I love talking about how long the Fed could potentially be on hold, because I'm always interested in the psychology of investors and how the market's watching the Fed and the factors that are going to influence the direction of markets, right? But if you think about the post-2008 situation, the Fed has always come to the rescue. And if we look at what the market was expecting before we got some of this stronger data, it was expecting the Fed to get up to the top end of their range and then immediately start cutting rates, right? But that's not an environment that's normal. So if we go back to 1995 to 1999, there was some movement in the Fed funds rate, but that was almost essentially 3.5 to 4 years where the Fed stayed at a high level, somewhere between 4.75 and 6%. If we think about the cycle back in 2000 and 2001, they stayed high for almost 8 months at the top end of their cycle. If we look at 2006 to 2007, they were at the top of their cycle for almost 18 months. And so it's a new phenomenon that the Fed has just been pumping so much stimulus in the economy, the balance sheet's been growing, and they haven't stayed at higher rates that would restrain economic activity for longer. But we think in this environment, given where we are, all the stimulus post-pandemic, that we could see an extended period at the top end of this Fed range for at least 12 months. So that's good news for your bond portfolios. We'll see what the impact of the economy is going to be. But ultimately, that's what we're going to see moving forward. The Fed's going to be at the top end for quite some time, at least 12 months. And then as far as interest rates and valuations, it's a really interesting question because this gets more to sort of private debt and merger and acquisition activity that we see in the market. And so money, to think about it, has essentially been free. So company valuations, corporate valuations have been very high, even with high levels of debt, but it's just been extremely high. And so now we're in a situation where all of these companies are having to revalue at much higher interest rates. And so the valuations, the sales of those companies, unfortunately, are coming down in terms of the price of buyers willing to pay. And so again, we think it's going to be elevated, right? Between 4 and 4.5% on the 10-year treasury. We think the Fed's going to be at 5 to 5.25. And so the valuations that we saw just about 12 months ago, 18 months ago, those aren't likely to come back, but the market is likely to normalize and get to a valuation point that's sustainable going forward. So I think in the near term, a lot of these valuations have been a lot lower than they should be, and they should correct. But I don't think a business owner should expect to have lofty valuations and multiples that they saw just 18 months ago.
Excellent. Another one that just came in, I wanted to touch upon this one. You talked about geopolitical risks earlier as being one of those 4 key things that we're watching in sort of that circular loop of risks that may be out there. We obviously take a look on the domestic front at the political environment as well too, and you touched upon the debt ceiling and the impact that might have on markets. But maybe looking a little bit further into the future, into the 2024 presidential election, what type of impact would something like that be having on markets in more of the near to intermediate term here?
Yeah, well, I think it's just another factor that's hard to quantify. And when you have factors that are hard to quantify, it creates volatility in the environment, right? And so if we take everything in total right now, we've got Ukraine, we've got an inflationary shock, we've got a pandemic, we've got the situation and tensions with China, right? We've got, a Congress that's having a lot of trouble reaching decisions, and kind of using debt ceiling and other things to sort of threaten the other party, and be in a situation where that could potentially destabilize some things, even in the Treasury market. The 2024 presidential election will just sort of be one more thing. And so I think until we start knocking down some of these individual exogenous risks, it's still going to play into a huge level of volatility, right? So we need to see some of these dissipate from the market. It's impossible to figure out what the impact is going to be, but it's just going to create swings. So ultimately, if we have more come in and we don't resolve some, it's just going to hurt the environment. But I'm hopeful that we can get to the end of some of these that we see in the economy now and have been dealing with for some time before we start adding in other ones.
Excellent. I think we have time for one last question I saw come in here. I wanted to touch upon this one. Mortgage rates. I mean, they're high. They're high, very high relative to recent history. Maybe not quite as high as they were back in the 80s that I'm sure many of the folks who know about. But why are mortgage rates, so high right now relative to recent history?
Yeah. So there are really two reasons, and these kind of fly under the radar a little bit. But if you think about where mortgage rates kind of tend to be, they tend to be about 1.5% to 2% over the 10-year Treasury. But what's happened in the current environment, if we go back to that concept that I talked about, short-term interest rates being higher than long-term interest rates, right? Banks don't make money in that environment, right? They don't want to lend in that environment because their cost of capital is higher than the level they can lend at. So to make mortgages attractive, they have to price them more expensively. And so we see an elevated mortgage rate that's closer to 3% over the 10-year Treasury because banks are more reluctant to lend, and you have to get above a certain level for it to be, for them to make money. And the second influence, if we think about the mortgage-backed securities market. So this was a market that was driven by a lot of refinancing activity, and it really provided a lot of liquidity to the mortgage market. That issuance, so how much of that specific sector was sort of built up in a current year, went from about $1 trillion in mortgage-backed security issuance just a couple of years ago to about 500 last year, and now it's projected to be about 150 to 200. So what that means is there's less demand for that mortgage paper. So again, mortgages have to be priced higher for investors to come into that market and support mortgages in terms of what they would buy, what they want to hold in their portfolios. So both of those factors, I think, are the two main components of why we're seeing mortgage rates that are well elevated above historical levels.
Thanks, Charles. Well, we're right about 45 minutes here as far as our presentation today, so I think we're going to wrap it up at that point. I'd just like to say from all of us at City National Rochdale, thank you very much. All of our clients, our partnership with the Davie Kaplan Wealthcare team. So Sam, thank you to your folks for helping us pull this together today. We hope you all found this very insightful. Feel free to reach out to your contact at Davie Kaplan. If you have any follow-up questions, we'd be happy to address those and get you additional information that you might be looking for.
Thanks, everybody.
Thanks, Charles. Thanks, Mike. Take care.